Hello, everyone. My name is Monica Harper. I'm the Executive Director of the AACFB, and I'm pleased to welcome you to today's webinar, Diversifying Your Product Offerings. Please note that today's webinar is being recorded, so all participant lines will be muted during the broadcast. However, you can submit a question at any time during today's presentation using the Q&A box, and they will be answered by the end of the webinar. Please reserve the chat for communication between attendees so your questions are easily identified by the presenters. And if you have a question you'd like to ask verbally, you can click the raise your hand feature and you will be unmuted to speak. Our presenters today are Tina Cawthorn with Orange Commercial Credit, Stephen Engel with Channel, Dana Freeman with Maxim Commercial Capital, and George Jensen with Community Bank and Trust. I want to thank all of you for sharing your experience with our audience today. Thank you so much. The objective of today's webinar is to provide some information about financing options that our viewers might not be as knowledgeable about, but they can serve as valuable arrows in your quiver when you're choosing the best financing options to offer your clients. So today we will start with an overview of SBA, and that is led by George Jensen. George, it's all yours.
Thank you. You can just click one more. There we go. SBA 7A loans. Community Bank and Trust actually has a division, which I'm the SBA sales manager of, that provides SBA 7A loans on a nationwide basis. I happen to be based out of Boston. But I refer to the 7A loan as the Swiss Army knife of loans, especially within the SBA world, in that you can use it for multiple different reasons, sometimes combining those together. But as you can see under this list for what it can be used for, about 65% of what we do is business acquisition loans, which includes startups such as franchises, but mostly existing businesses that, for a buyer already have existing revenue, customers, and profits, which is a great thing to do. It can also be used to buy out a partner or partners in an existing business. Can be used to acquire business occupied real estate, just has to be 51% owner occupied by the business the borrower is running. Can include construction or renovation dollars. We even do ground up construction for a variety of businesses, including construction that might be related to the build out for a new franchise or the redo of an existing franchise. You can finance equipment and leaseholds, and oftentimes, whether it's a business acquisition or other type of loan, we also include some working capital. And for those types of loans, except for the commercial real estate, it's a 10-year fully amortizing loan. For commercial real estate, we can actually do a 25-year term for repayment. Some of the key features can be as low as a 0 to 10% down payment. Let's talk a little bit about that. The 10% down payment is the minimum required for a business acquisition, where the 0% down can come in is you can do that with a partner buyout, or if you're an existing profitable business and you're looking to go from being a tenant with a landlord to buying either the location that you currently rent or a new one, and you're profitable and you can meet the debt service requirements, SBA allows you to do a 0 types of deals. As I said before, it's a 25-year term for commercial real estate. The other uses are 10-year terms. On that 10-year term, there's no prepayment penalty. You can pay it in part or in full at any point in time, and all you do is pay out your existing principal plus the accrued interest from your last monthly payment. On a 25-year loan under the 7A program, it actually has a 3-year prepayment penalty, declines 5%, 3%, 1%, so that by the 37th month, you could refinance that or pay it off without any prepayment penalty being incurred. The last item where I thought investors are okay without them providing personal guarantees. From a personal guarantee standpoint, anybody that is a 20% or more owner of a business is required to be a personal guarantor on the loan. Today, there are many business acquisitions that are being done with that 10% down payment up front, where sometimes up to 90% of the cash needed for that down payment is provided by investors. And as long as those investors are holding less than a 10% ownership, they don't need to be a guarantor. Um, some of you might be familiar. They refer to these as search funders, people that are out searching to buy a business, but they need the help from investors to make the down payments. Can slide. Yeah, there we go. The other thing about SBA 7A loans is the source of the down payments, or in the SBA language, they refer to it as an equity injection, which we do have to verify. We just really look at the prior 90 days banking activity for the individual and or their business, just to verify that they have had those funds on hand and that they're not borrowing that money. So the sources can be as simple as personal or existing business cash. You can receive a gift of funds towards that down payment, but it usually has to be from a family member. Um, while the SBA regs say that you cannot borrow money for a down payment, there is one exception. You can actually use a home equity line to come up with part or all of that down payment. In a minute, we'll show some examples of the use of some of these different down payment sources. The next one in the lower left is funds from a retirement account. That can be an IRA or a 401k from a prior employer. There's actually an IRS approved tax-free program called the ROBS 401k, where you can roll money from that retirement plan into a 401k that's set up in the company that you have, set up either to buy an existing business or you have an existing business, and you can pull funds tax-free, put it into, roll it from your own individual retirement into a retirement account in your business company, and then you buy effectively stock in your own business and can use that for either a down payment or working capital. Also, starting in November of 2023, the SBA came up with a creative approach to that 10% down payment. They now allow individuals to, let's use a quick example. Let's say it was $1 million deal. A 10% down payment would be $100,000. Previously, you had to have that 100,000. Now you can go as low as 2.5% or 25,000 from the buyer. And as long as the seller provides a seller note where the first 24 months are on standby, and standby means that it's either interest-only payments for those 24 months or no payments of principal and interest. Usually the difference is you just need it one way or the other to meet the service requirements. So in that instance, with $1 million deal, the seller would put up a $75,000 note, and they would get interest on it, but that would be counted towards the 10% down payment. And also, like we mentioned a little earlier, you can use investors to help you raise probably up to about 90% of that down payment. So next page or slide. Thought maybe providing some examples of some recent 7A deals we've done. The first one, it was a purchase of a real estate business. They used a HELOC, a home equity line of credit, to provide that 10% down payment. And obviously for all of these deals, we do have that debt service coverage requirement. We actually use the SBA minimum, which is 1.15 debt service coverage ratio. A lot of other 7A lenders use 1.25 or 1.5, which makes it a little harder to qualify. Second example, $2.7 million manufacturing deal. The down payment was used with the benefit of that ROBS 401k, meaning you're moving on a tax-free basis funds from an individual retirement account or 401k simply into the 401k you now have established in your company. And that's a great option for people that don't have any other way of doing this. The third one, purchase of a beauty salon and its commercial real estate. This is the one where I mentioned that instead of having to come up with the full 10% down payment in cash, they were able to only put down 2.5% cash because the seller gave a seller note or standby note equal to 7.5% of the purchase price. And that allows you to cover, it says here minimum 20% down payment. It actually should be 10%. But that's a very creative way and one that's getting a lot of traction for people to do these deals. The last one, 1.5 million, this was an add-on acquisition where an existing manufacturing business bought a competitor in the same business. SBA allows you to do that with a 0% down payment. And that's allowed when you're buying the same type of business, which means it has to match the NAICS code for that business. One other thing that maybe we didn't mention is that you can actually use SBA loans to refinance existing debt. Many times we see a situation where somebody will come in and say, you know, I've got $400,000 or $500,000 of higher interest debt. I'd like to reduce those payments. And also I've got 200,000 of equipment and maybe I need another 100,000 for working capital. We can actually combine those all into one loan and help the borrower out. So it's a very flexible program. Many times, or the primary use of this program, and the 7A program's actually been around since the 1950s, is that you may have a business that's a strong business, but it lacks collateral, and it's very difficult to get conventional bank debt, especially for a business acquisition. But the 7A program provides the lender a 75% loan guarantee, which allows them to be much more aggressive on lending in situations where a conventional bank lender would say no.
Great. Thank you, George. This is Tina. I'm with Orange Commercial Credit, and we have been an AACFB member for a number of years. And I know there are several factoring companies within the association. And I will say that, you know, they all might operate just a little bit differently, but I'm going to spend a few minutes here just talking about invoice factoring in particular. And I will say that I'm really happy about the number of people that have joined or are participating in this webinar, because it is very important, whether you are a broker or a funding source, to have product knowledge of a diversification of products. It's great, it's a great association where we all help each other out. So even if you're a funding source listening in today, it's good for you to know about these other products other than your own. Because if you can't do it, obviously you want to refer it to a reputable funding source that can help the broker or the direct prospect. All the products today are really encompassing working capital, which, as we all know, is really the heartbeat to a business. And there's a variety of ways for a prospect to access working capital. And so it's really a great opportunity, if you're a referral source, to know about these products. And as Monica said, have a few arrows in your quiver. So with that being said, invoice factoring in a nutshell is really about cash flow acceleration. It's a non-debt product because a prospect is exchanging one asset, which is a receivable, for another asset, which is cash. And so it is an off-balance sheet method of business funding and does not create debt for a company. I like to say it's the best kept secret in commercial funding, because a lot of People are unaware of this product, even though it's been around for thousands of years. So there are factoring companies out there that are buying the receivables or the invoices and advancing immediate cash. So it is very transactional, where in other products, you'll get a lump sum working capital loan, etc. Where with invoice factoring, it is very transactional with each invoice that the company is generating. So many factors will offer to buy aged invoices for the first purchase. And then from that point forward, anytime the prospect creates a new invoice, they'll submit it to the factor rather than sending it to their customer. The factor will advance them the funds, the prospect the funds, and then push the invoice out to the ultimate debtor, the client's customer, with instructions for them to remit the payment to the factor, since the factor has already advanced the funds to their client. So this is again, it's a non-debt product. It's not there is no interest component involved in this. It is a discount on the face value of the invoice. So what the client is getting is a percentage of the face value of the invoice. It kind of comes down to the time value of money. Is it worth a slight discount on the face value of an invoice to get paid today, rather than waiting until the prospect's customer decides to pay them? So, do they want to have all those outstanding receivables? Do they want to be the bank for their customers, or would they rather get paid today so they can keep the wheels turning and the business in motion? And if so, there's a variety of products, and invoice factoring is one of them. Stephen, if you could please advance to the next slide. So in invoice factoring, there are three participants. There is the client, there is the factor, and there is the client's customer, or the ultimate debtor. And on day one, when the client delivers the goods or completes the services, they will send the invoice to their factor, and the factor will provide, advance the funds to the client, push the invoice out to the customer, and then they do the waiting to get paid. Typically, it's 30+ days. So this allows a business to provide payment terms to their customers, but gets them paid typically within 24 hours of uploading their invoice to the factoring company. Next slide, please. So what are the benefits of invoice factoring? The biggest benefit is it accelerates the business cash flow. Those funds belong to the client. Rather than hanging out on their AR aging report, they're just accelerating them faster. So it's their funds. They can do with them what they wish, whether that typically just means timely meeting the daily operational expenses. If you have a prospect that has a huge amount of outstanding receivables and they don't qualify for whatever reason for another product, or they're looking for something really fast that can get cash for, maybe you're doing an equipment loan and the lender wants a down payment, but the client doesn't have any money in the bank, but they have all these outstanding receivables, then a factor would be able to, if they can approve the credit on the debtors, then they would be able to generate enough cash, potentially, depending on what, how much the down payment is being needed and what they have in outstanding receivables, to get them the funds to make that down payment so they can get that equipment deal done. You can get that done for them too. Invoice factoring is the primary focus in underwriting is on the credit strength of the debtor. They're the ones making the payment of the invoice, right? So the underwriting focus is typically on the client's customers, though most factors will want to know a bit about their client as well, and most will pull personal credit to see what that's made up of. The typical factoring company doesn't we don't get any bank statements or financials, anything that you get for other types of loan products. We typically just get an application and driver's license for identity, and we go from there. So it is very quick and easy to use. And so for the clients, they can, they're also getting back office support because a factor will do ongoing credit monitoring and collections of the invoices that they factor. For a referral partner, you get the benefit of residual monthly income. So you're building an annuity stream when you're offering factoring products. Most factors will pay you a monthly commission, and it's typically based on the amount that the client factors in that particular month. So you don't get the one-time big commission when you close a deal. You're going to get monthly for as long as the client factors. And again, factoring is super easy to get set up, and it is a solution that can help with timely operational expenses. And that would include, obviously, equipment payments. So if you're a lender out there and you have clients that are telling you, I'm late for my equipment payment because I'm waiting to get paid. Well, this is a great solution where you can say, hey, have you ever considered factoring? And so it's just a great segue into offering a value-added service. Next slide. So who uses factoring? Companies of all sizes and in most all industries use factoring. Most factoring companies have a specialty. Some specialize in transportation, some specialize in medical, some specialize in construction. I would say those are the three big ones, big industries where this is utilized, as well as manufacturing. It could be a prospect that is rapidly growing. Maybe they're undercapitalized. Maybe they're with a bank and a bank is asking them to leave for whatever reason. Honestly, we have everywhere from startup entities to large conglomerations that are using factoring just for the simplicity of the product. So there's a variety of reasons that the prospect might consider factoring. Next slide. So if you are talking with if you're a funding source talking to an existing customer, or you are a broker and you're talking about other products, if you hear any indication that the prospect has a slow pay cycle, maybe they have a short-term cash flow need, or whatever the reason, they're unable to meet their time, operational expenses. They might not have good business credit, but they've got a good, strong customer base. And those are all prospects that might consider invoice factoring. Stephen? So how do you identify an invoice factoring prospect? It must be doing B2B commerce. And you might see where they're offering payment terms, and maybe you'll even identify in your credit review that they're already offering a discount to get paid quicker. Maybe you'll see that they're offering payment terms, like 2%, 10 net 30, which is an indication they're already willing to take a 2% discount to get paid within 10 days, right? It's the same thing as factoring. It's a discount on the face value of the invoice to get paid today. So there are other ways to identify a prospect other than just ask the questions about how quickly they're getting paid, and if they indicate in any way, shape, or form that they're struggling. They have to extend the payment terms, but they want to get paid quicker. Then factoring is a good product for them to consider. Next slide. So that's it on invoice factoring. And again, that is just a quick high-level look at the product, and we'll take questions at the end, I believe. So if you have any, please let me know.
Thank you, Tina. So to set the table, I just want to start off by saying this is going to be a very high-level quick presentation on working capital. If you want to get into a slightly deeper, more exhaustive presentation on working capital, we did one last month. It's saved to the AACFB website that you can reference, where we get into a little bit more detail. Myself, and a counterpart, Corey Krogan, and myself. So if you're interested, you can reference that. And then also just diversifying your product offering in general. There's a couple different schools of thoughts around that. And if you're John Deere Financial, or you're Ford Motor Credit, coming out and turning around and selling factoring or working capital or SBA loans or debt consolidation or whatever you're doing is probably not in your best interest. It's it's probably not something they're going to do tomorrow. But if you think about how a bank operates, first and foremost, we're interested in how to get people to put deposits into their account so they can turn around and make a profit about on that money. But a bank offers a number of different services, and a lot of the school of thought there is, how do they keep people in their ecosystem? And you should be thinking no differently about your business. If you think about one of the most expensive things that you have in your business, it's the cost of originating that customer the first time, getting them in the door in the first place. And from 0 to 10 years for a small business, in all likelihood, statistically, really, chances are they're going to fail and that business won't be around. But the businesses that do make it to 5 years, 10 years, and more, as they start getting more mature, they're going to need different financial products at different life cycles of their business. And 1 year it might be factoring, 1 year it's going to benefit them. In the meantime, you know what? If you can make some money off of it, that's the ultimate goal, right? We love to help people, but at the end of the day, we're all here to make money, right? It's our job. So hopefully you can learn a thing too about working capital as well, and it's something you can utilize to benefit yourself, your customers, and everyone around them. So again, this will be a little bit high level. So for those of you who are familiar with working capital, this may seem a little bit elementary. I apologize. Working capital, what is it? It's non-traditional funds used for business financing, businesses that need capital. It's unrestricted, unsecured financing, which might be different than a lot of other different financing types. It is considered a higher risk product by banks and lenders, and it's priced accordingly. It's used for a variety of different lending sources, servicing all different credit profiles, from what you might consider a bankable or an A credit, all the way down to challenged or subprime credit types, and then transaction sizes all the way from 1,000, which would be more, maybe a credit card type transaction or a micro ticket, what you might call, all the way up to 5 million and above. And I put above there because 5 million is the biggest I could find, but I'm sure there's folks out there that do much bigger. And generally speaking, when I talk about this, I'm going to use terms like generally and typically, because what I say is 95% true. I'm probably going to say some stuff that maybe you can find an exception to the rule, but generally speaking, what I'm talking about, I'm trying to encompass a bunch of different lenders in the industry. I'm not saying something completely specific to channel, or I'm trying to keep it very general to the working capital industry as a whole. Working capital, some of the benefits, why people use it. It's super flexible. It's super fast. The credit package is super small. It's generally speaking an application in 3 months banks. So you're not going out and getting financials, let alone audited or reviewed financials. Like I said before, it's unrestricted and unsecured financing. You don't need collateral usually, and liens are not common. Occasionally, a lender might want to use CC1 or throw a blanket lien on a business. But I'd say that's starting to become rare, or a lien might be the exception rather than the rule. And then limited or no covenants. And when I say limited or no covenants, you may have a covenant or a rule in your documents that says, hey, if you take this loan, you can't go get another working capital loan. But it wouldn't be any traditional bank covenants that you would see with a traditional credit line, because ultimately you're giving someone funds and there's not really a whole lot you can do to monitor the use of those funds. So it's kind of a moot point. Working capital, right? This is working capital is opportunity financing. It's a little different than the factoring or there's some overlap with the factoring, but really it's not the same. And same thing with the SBA loans. Working capital is all right time, right place, right opportunity, and then it's the convenience of having that financing. We tell people all the time, or we tell our partners to tell their borrowers, if you can go to a bank, why wouldn't you go to a bank? It's more expensive. However, if you have an opportunity and the opportunity return exceeds the cost of your financing, then you have a viable opportunity on your desk that this might make sense for you, right? But if you have the time and you can go get a factor, or you have time to wait and you can get an SBA loan, then that might make more sense in this case, because the cost for those types of products are probably going to be a little bit lower than my cost is. However, if you need to go tomorrow, I'm ready to go. Here's the approval, and I can go pretty fast. And generally speaking, that's going to be true with most other lenders and working capital in general. That's just the way it works, because it has to work that way. Those opportunities come and go so fast that you want to enable those borrowers to be able to say yes and move fast. General use of funds, numbers, these aren't numbered, but credit lines and project financing, basically 99% of your use cases for financing and working capital can kind of be lumped into either using it like a credit line or using it like project financing. But generally speaking, in all different industries, they're using it as credit lines, inventory, project financing, reserves. We call this kind of sleep good at night money, where someone might have a senior credit line, but they need something in their back pocket for something specific, or they need something in their back pocket for when they have cash flow constraints and they just need that additional working capital for if and when something goes bump in the night, and they have something to fall back on, and they'll get a working capital approval, or they have a source that they know they can get it from. New hires, renovations, marketing, expansions, soft costs, premiums. The list goes on and on depending on what industry, but these are some common ones that we typically see in a variety of different industries that kind of cross over. And then again, not to cannibalize anybody, but often working capital is extremely complementary to some of the other products mentioned here, especially equipment financing. A lot of times you hear, or a common thing might be is, hey, I have 5 forklifts, one broke down and I'm just replacing it. And so I need equipment financing. Well, to me, that doesn't suggest that someone immediately has a need for cash. I might ask them anyways what's going on in their business, but to me, that doesn't scream, hey, there's an opportunity for working capital. But most of the time, that's not the case. Most of the time, it's, I have 5 forklifts and hey, I need at least 2 more. So Mr. Broker customer or lender customer, here's my application that I'm going to fill out. I'm looking to lease 2 forklifts from XYZ vendor. To me, that says growth, right? There's a growth opportunity there, which, okay, like, are you hiring more employees? What's going on in your business? That's an opportunity to ask more questions and possibly add a credit line there or offer them financing. At the very least, dig into what's going on, because a lot of times adding additional capital goes hand in hand with that equipment purchase. And it's like a great marriage. A coworker of mine always says it's the burgers to your fries. So often it's very complementative, and we have found that, right? So that's all I got. Dana?
Cool. Hey guys, Dana Freeman from Maximum Commercial Capital. Just going to get into how real estate can be used as an alternative to get working capital. And one of the things, as you know, I'm assuming the majority of the folks on today, their main source of business is equipment financing. That tends to be the case with the AACFB. The other products, whether it's a revenue-based working capital like Stephen, or Tina with the factoring, or George with the SBA, they're all excellent products, and this is just another alternative product to have to help get deals done. A lot of times you hear real estate, you think of traditional mortgage-based real estate loans or commercial real estate loans. But there are products available. You can go ahead and go to the next slide. There are products available that would be more using the real estate as the collateral for a working capital loan. So it wouldn't be a mortgage. It'd be more of a short-term business loan, typically like a 60-month loan. Excellent uses for it would be to, unlock some liquidity if there's a lot of equity in real estate and a business owner is needing some capital. It can be a great way to access capital that maybe they wouldn't qualify through a traditional bank, or maybe their revenue isn't to the point where revenue-based working capital loan would be a good fit. So using that equity that's tied up, that money that's tied up in the real estate for their business can be an excellent way to get money. Also, there can be some flexibility on credit, on business financials, because the asset of the real estate protects the lender. The other good source, the other good option is to pay off expensive debt. So, pardon me, if someone's gotten into too many short-term working capital loans or like MCAs, maybe they gotten backed into a corner where maybe they have too much of that and it's burdening their cash flow. This can be a good way to refinance that debt by leveraging the real estate. And go to the next slide. I apologize, I have some bad allergies today. Sorry about that. Real estate that can be used would be retail, industrial, multifamily, residential. Raw land or infill land is getting more challenging, and also office right now. I'm sure a lot of you have heard the office market is very challenging right now. So right now, for most lenders, the retail, industrial, multifamily, and residential would be the preferred collateral. Office and land would be maybe a little less preferred. It can certainly be considered if it's in the right location, or it makes sense. But for the most part, multifamily residential is very popular. Also the industrial. We can go to the next slide. So typically, the reason someone would use these types of programs would be if they have, like I mentioned earlier, capital tied up in real estate, maybe some expensive short-term debt they want to pay off and get to, from a daily or a weekly payment to a monthly payment, and stretch the term out. Many times working capital loans can be shorter terms. So sometimes to build a cash flow, a business might stretch the term out, like going to a 60-month term could make it more affordable if they're running into some cash flow issues. It can be used for bridge financing, funding projects, getting working capital fast. Now, when I say fast, maybe fast compared to like an SBA loan, but certainly not fast compared to a traditional working capital, or I'm sure something like factoring, if it's a fit, is relatively fast. So fast relatively compared to certain things. Also, if they've been turned down at a bank, maybe they have credit challenges, low FICO scores. Those things can be overcome by having the collateral be strong, like a real estate asset that's being pledged. We can go ahead to the next slide. So here's some examples of deals that can be done. These types of deals, depending on the lender you work with, can go anywhere from 100,000 up to a few $1 million. But a lot of times the sweet spot for clients is between 100 and 500. Most of the time, a lot of these folks that maybe you've worked with as a broker and done equipment deals for, most of them aren't going to need millions in working capital. I mean, it happens, but a lot of times it's just they need a couple 100,000 to get by. And here's some examples. 200,000, 60 months, and certain lenders will be able to do not just a first position lien, but a second position lien. So being able to utilize that second position, or even sometimes a third position, as long as there's enough equity, can be a unique way that a lot of people wouldn't even think of. So I think one thing as a broker, all of these different products that are mentioned today, I think it's just important to keep those in the back of your mind. So when you run into the scenarios where it could be the perfect tool for your client, you'll remember, and then you can just use that and then get a deal over to Tina or Stephen or George or myself. These can be excellent ways to augment your income with new deals and potentially help your client in a way that maybe in the past you wouldn't have been able to help them with if you are just doing traditional equipment finance. I mean, certainly equipment finance is an excellent way to help clients, and as a broker, that's probably the majority of what you do. But then if you can supplement that by helping out with some factoring, helping out your clients, and just having those multiple offerings. So when your client has a need, you have the right tool for that particular need. That's going to earn those clients, where they'll just keep coming back to you because they realize, this person I'm working with is super knowledgeable. It's not just helping me. They're not just helping me with my equipment finance. They have all these other solutions I didn't even know about that they've educated me on. And now, I'm able to get my money faster. I've been waiting, 30, 60 days, and now I'm getting the money faster. Or maybe they have a potential expansion in the future and they want to, do something and get a new building, do an SBA loan, or they're needing that short-term quick working capital, and they want to do that revenue-based working capital, or they might have a situation where revenue-based doesn't work. Some of these other products don't work, but you remember as a broker to just ask, hey, do you have any real estate that you have a lot of equity in? And it could even be their primary residence. That's one thing that a lot of people don't realize is they always think, oh, it has to be related to the business, but that's not the case. The real estate can be their primary residence, except in the state of Texas because of homestead laws. So that's a really unique thing that, most brokers wouldn't even think to ask is, hey, do you have equity in your house? Do you have a rental property? Do you have the building your business is in? Do you own it? Do you have a lot of equity in it? Any of those things could be potential solutions for working capital. So we can go to the next slide. Oh, questions. There we go. Thanks, everyone. I appreciate you attending, and certainly we'd all be happy to answer any questions.
Thanks, everybody. Yeah, so I see a couple of questions. Again, if you have a question, please put that in the Q&A box and we'll get that answered for you. First question is, what kind of credit review is done on the debtor to determine if you will accept the invoices? I think this is for Tina or anybody that does invoice.
Good question. So we don't initially contact the debtor. We pull published reports, go out, and first of all, we check in our database to see if any of our other clients are already have been approved. These have been approved for any of our other clients, and if we can't find them in our database, then we go out and just pull published reports. I don't honestly know what is being accessed. My underwriters take care of that, but they're pulling published reports to see how they're performing on their patrons.
Next question is, will we send out slides and contact information? This is the contact information for all of our presenters. So if you have a specific question about the product that they presented on, or if you have a specific question about what their company does specifically, then please do reach out to them. And we will be putting this recording up on the members only section of the AACFB website in our online video library. So you'll be able to, members can access it whenever they want, if they want to go back and review the information. Can we have the names of the lending company, the contact details of each person that makes this presentation? Okay, that would be on the screen. So, if anybody wants to verbalize their question, they can do the raise the hand feature and we'll allow you to speak. Sometimes it can be a little wordy if you need to, there we go, to type it all out. So Bo, you should be able to unmute and speak.
Okay, hi everyone. My first question is for George. George, are you guys a PLP? You're on mute.
Oh, we can't hear you.
Yeah, Bo, good to talk to you. Haven't talked in a while. We are a PLP lender, yes, and we lend nationwide, including Alaska and Hawaii.
And what is your, where do you think you guys are most competitive in what space, what vertical within SBA 7A?
We pretty much will consider most industries. There's really only two that we won't lend into, which you may not come across that often. One is the oil and gas development or exploration, and the second is the logging industry. We've just found those to be too cyclical. But otherwise, we've probably done a loan for the majority of other industries out there, but we do a lot of business acquisition, and we do quite a bit of new franchises as well as resale of other franchises. But actually getting ready to close a loan up in Alaska right now for a services company that provides construction capability in the oil and gas industry, for an example, which is not exploration, but just another indication of where we're doing them all over the place.
Okay, great. I do a lot of franchise startups. Are you guys open to home service industry without brick and mortar location?
Yes. Yep. Doing one now.
All right, I'm gonna ping you offline because I've been doing it 3 or 4 months. Next
Okay.
question is for Stephen. If I could ask one more question.
Sure.
Stephen, I've mostly broker SBA loans at this point in my career. I've always said to myself, I want to get more into, working capital alongside what I'm doing with SBA. Is your program really like your factoring? I mean, not factoring. Your MCA. The way you price is on advance. Are you doing like an MCA product? I guess is the question.
Kind of. I wouldn't consider it a merchant cash advance. When I think of merchant cash advance, I think of credit card receivables and taking a percentage of those. We do work with a number of SBA brokers and lenders, and the way we kind of tie in there is, look, their primary business is getting an SBA loan done. But what we'll do to tailor our product specifically to make it make sense for them is they're working on a graduated SBA loan, and that might take 3 months, it might take 6 months. So what I'll do is I'll write a term debt note for 12 months or 15 months or whatever makes sense for them. It typically be a much smaller amount, but it's something to get that borrower started. And then I'll put a specific schedule in there to say, hey, if you pay off in 0 to 3 months or 4 to 6 months, I'll cut the interest in a third or half or whatever it is, depending on the length of the note. So I'm not completely gouging that customer on a 15-month note. I'm making it, the financing cost, very reasonable for them. And then when the SBA hits, they can pay it off because they get a lump sum of cash, or they still have the option to stretch that out over 15 months if that's what they want at the time, right? They always have that option. But the sale is, hey, here's the money now, get started, and then pay it off when the SBA loan hits. And we've been very successful with that, and it tends to make sense for borrowers.
So is that so you're collecting a one-page app and 4 months bank statements? Is that how you're underwriting?
Yeah, 3 months of bank statements, unless it's in California, they require 4 months of bank statements.
But so you're not charging a factor rate, like on MCA deals, or this is a factor rate of 1.49. You're actually an interest rate type of work.
No, it's a factor rate. It's a cost of funds product. So in essence, I'm giving someone $10,000, and I'm making this up because it varies. But I'm going to say I'm going to give you $10,000. You're going to pay me back, $12,500 over 12 months, right?
Okay, got it. Thank you. Thanks for the clarification. I'll connect with you too if I got your contact information. And I know
Beautiful.
Dana. All right. I did submit one and I got a pre-approval, but the guy ended up backing out with your group, Dana. So it was a easy experience. So yeah.
Okay.
I need to get you one closed though.
Yeah, sorry, I was on mute. I was just saying, appreciate you trying us, and yeah, hopefully we'll get the next one.
Thank
you. Do you have any other questions? I think he's done. I had a question.
I have one more question if I can hog the stage.
No,
here.
go ahead.
Going back to Tina, factoring is always interesting. I haven't done any factoring deals, so it's good. Thank you for putting this on, by the way. Going back to George on a franchise startup, because I'm doing a ton of them, because I also own a franchise brokering company.
Okay.
And so I'm primarily working with two banks right now. One is name is Huntington Bank, and another bank in the Midwest that does the small ticket deals.
Midwest.
Yes. And so I'm trying to build a bigger arsenal because I'm pretty networked in. I have CPAs referring me their deals and so forth. So I'm getting 3 or 4 or 5 of them coming in pretty steadily. And so like I understand Huntington's buy box, 80% loan to cost. They want to see 10% post close liquidity. They want them to score in the SBA credit scoring model. As long as it's approved on the SBA directory, I know it's discontinued, but that's how they are, or they're Fran Data certified, they'll look at the deal. If not, they won't. Can you kind of give me your forte of what you think your bank will look at? So I have your buy box for franchise startups, because I'm doing them left and right here.
Yeah, we'll actually go up to 90%. I'm doing a boxing franchise out in California right now where that's a 10% down for the first time buyer. With regards to post-transaction liquidity, we obviously want to see some, especially depending on the type of business. But most of these franchises that we're doing, there's no receivables. It's a situation where the customer pays at the time of the service is earned, or it's a subscription like an exercise group club or whatever. So the post-transaction liquidity, we just want to, we're not stuck on a hard fixed percentage, but if somebody's putting 10% down on a $1 million deal or $500,000 deal, we're not looking for them to have another 10% of post-transaction liquidity. We want just to be comfortable that, we have a one-pager, just like a lot of lenders, personal income and expense summary. And as long as we can see that they're covering, their family and living needs comfortably and have some additional cash, or perhaps a home equity line if they ever needed some additional cash for the business, we're fine on that. With regards to the franchise directory, you're right, that isn't required any longer. Probably the only situation where we're less likely to do a deal is where it's a brand new franchise and they may have 3 company-owned locations and they have 2 franchisees signed up, but they haven't opened any yet. That's probably just a little too early for us.
Got it. Okay. Yeah, I have a lot more questions, but I'll kind of I'll tailor that because I don't want to bore everybody, because I just like to get the understanding. Last question on this part though is obviously everybody uses prudent lending, but some banks SOP, if the loan amounts are under 500,000, do not require additional collateral. On a franchise deal, like I was working with one bank and like we lost a deal because they're like, hey, we'll do this deal, but we want to put the loan was under 500 and they wanted to put a lien on the house. And the guy was super strong. There was no reason for them to do it. I went to this bank because their pricing is extremely good because they're balance sheet them. But like, are you guys going to be doing stuff like that? Or obviously if it's a hairy deal, I understand that. But if it's like a pretty cookie cutter deal, will you guys like say, hey, we don't need, it doesn't say we have to take additional collateral on loan amounts under 500,000.
Yeah, no, we will follow the SBA guidelines under 500, that there's no collateral requirement, as long as, like you just said, there's no hair on it. If somebody's got good credit, the business, either that they're buying that's existing or it's a new franchise, shows good cash flow in the first 12 months, we'll do it without taking the personal residence.
Okay. And last question for now.
Yeah.
The most important question is, how is your comp structured with brokers? Do we charge on top, or do you guys pay a referral fee?
We pay a referral fee. And I believe I might have shared that with you previously, but I can provide that to you. We consider ourselves to be above what most people are paying for referral fees on SBA loans. And also, and I'm drawing a blank what I was just going to say, but refresh my memory, Bo. What was your full question again?
I was asking about comp, and then also the last follow-up is, do you do anything for military veterans as far as discounts on margins or anything?
We currently are not. We have on occasion in the past done that.
Okay, good. We'll talk offline. I don't want to keep everybody.
Yeah.
Thank you so much for answering all my questions, everyone.
Thank you, Bo. Tina, there's a question for you on invoice factoring. How is recourse structured?
Structured. So most factors recourse is 75 to 90 days. So I would say that's the structure. For those of you not familiar with recourse, what that means is when a factor buys an invoice, they buy it for a specific period of time. Their pricing assumes they're going to get paid within that period of time. And if they're not, then it is sold back to the client, which is not something that anybody wants happening. So that is the purpose of doing the credit checks on the debtors ahead of time. There definitely are factors out there that'll just buy anything because they know they've got the recourse period. Other factors prefer not to operate that way. It's counterproductive for everyone. So if you have a good factor, they're doing the ongoing monitoring and they have a low occurrence of any type of recourse happening. So that's just kind of a high level about recourse. I hope whoever asked that answered your question. If not, give me a call and we can do a deeper dive on that.
Thank you. This is for George. In general, how long does it take to get an approval on SBA and close an A&F fund?
Not quite sure when you're saying A and F, but
maybe it's a typo, maybe and fund,
yeah.
or I don't know.
Yeah, but
maybe close and fund.
Oh, okay, there we go. Yeah, if we have once we have a complete package of information with a deal that does not involve real estate, our goal is to close that within 45 days. But on the upfront part, once we've got a full package, our goal is to get back to you within 48 hours with an answer as to we can do this deal, or we like the deal, but we need to tweak how it's set up a little bit. And we would also be able to provide a term sheet with the terms for the deal to the customer. And then we would move ahead to, the full underwriting of the deal and closing. Now, if real estate is involved, where commercial real estate, you typically for a 25-year loan need to not only do an appraisal, but also a phase 1 environmental. Again, our goal is to not allow that to extend more than 15 days beyond that 45 days. So with real estate involved, if it's a combination business and real estate deal, we'd hope to do that within 60 days. If it's real estate only, we'd still try to do it within that 45-day period.
And typically, what's the max point a broker would make on that?
The max we offer on a 25-year loan is 2% of the loan amount, and on a 10-year loan, it's 1.75. It does get adjusted somewhat depending on the rate that is agreed to with the customer. If we need to be more competitive and lower the rate, which lowers our yield, that will impact somewhat the referral fee. But I can provide anyone that would be interested a copy of our referral source comp sheet.
Are SBA loans fixed rate or adjustable, or how's that work?
The majority of them, including for Community Bank and Trust, the 7A loans are variable. They're prime plus loans. The maximum 7A rate is prime plus 3%. So today with prime at 7.75, the max rate would be 10.75. Once a borrower's loan is closed, that loan actually adjusts on a quarterly basis as to how the prime rate goes up or down. Fortunately, more recently, we've been seeing several, rate reductions in prime, and we're hoping to hear another one sometime this month or in January. And borrowers benefit from that drop in interest rates. Obviously, if rates go up, they also get hit with that slightly higher rate.
Right. Okay. Well, we are out of questions and out of time, so that worked out perfectly. I want to thank everybody for their time today. I want to thank our presenters for their expertise, and I hope that our attendees learned something that they might be able to offer in a particular situation so that they can be the most valuable to their customer. If you have any questions offline, please feel free to reach out to our presenters. And with that, we will wrap it up. This will be on our website if you want to go back and review it. And everybody have a great day.
Thank you, Monica.
Thanks, everyone.
Thanks. Take care.